this one, Leslie?
Thomas, we're
94.
back.
All right, we are back. My name's Tom Sosnoff. I'm here with Tony Batista. You're listening to Get Tasted. Good show today so far back.
It's been very fast-paced. It's been very nice.
It has been fast-paced.
January's safe for everybody.
All right, I'll make January safe. In the house, Shelley Natenberg. How are you?
Fine, thank you.
Welcome. I know you're not. I know you're not the huge public figure, but you know, I told a story, Shelley, the other day. One of the guys that I hired, who's on part of this team here, his name's Tom Preston, and I don't know if you know Tom, but
No.
Tom wrote all the volatility models for Thinkorswim, and he now is part of the Tasty. And when I first met Tom, I hired him. He was working at Microhedge, and writing their models for them. And he opened up his briefcase, and inside of it was a knife, because he's insane.
A Bowie knife.
A big knife, and a copy of your book. So we had this very fascinating discussion, and from that point on, it
One
was
that would not get heated.
it was entrenched in my mind, okay, forever. So you have the reputation. There's two Bibles in the option world. One being Larry McMillan's Options as a Strategic Investment that all of us were forced to read when we first got in the business, and your book, with the only two books I've really ever read in this space, and since then pretty much not much else. Let's talk about it. How I know your background, where you traded on the CBOE floor for a while, and then you also traded on the about 15 years on the Board of Trade.
Right.
So you have this trade, but you popularized, I think to a certain extent, you popularized volatility. When I first started trading, I think you started in like 82.
Right around Christmas, 82.
Because I started in 1980, and Tony started just at the
83.
beginning of 83. So we're all about the same time.
Right.
But at the time, like, I'm not sure I knew what volatility was. Like, when did it become popular?
Well, I mean, I guess volatility trading was done a little bit when I came in, but certainly toward the middle and late 80s. You know, we have this term Vega.
Sure.
The term Vega was not around when I started, really.
That's what I'm saying.
Because people didn't. I mean, I've talked to a lot of older traders that started in the early mid-'70s when the CBOE opened, and you know, they knew about gamma and they knew about theta and they knew certainly delta, but who knew about volatility? Because nobody thought of it, nobody had worked with it before, because nobody cared about it when you traded stocks or futures. But of course, over the years, as there were disasters and also lots of money made when markets became very volatile or non-volatile, people started to pay more attention to it. And so they realized that they had to look at the risk, the sensitivity. And, theoreticians hate the term Vega because it's not a Greek letter. You know, everybody likes Greek letters. So I guess somebody said, well, let's find something that starts with a V, and they came up with Vega. And you started to see Vega on risk sheets, I would say more consistently, about 85 or 86.
When we used to lose a lot of money
and couldn't figure out why,
we would say, this is my first definition of volatility. How did I lose so much money?
Right.
I'm covered here.
That's how I used to define volatility. Yeah. How did I just lose so much money?
Or why did I buy a call and the market went up and the call went down? What was that all about?
That was our definition of volatility. How did I lose so much money? It would drive me, you know, I mean, I'm not, people think like now that they don't
it's
realize,
so sophisticated.
Shelley, how the retail software today, I don't know how much. I know you work with Chicago Trading Group, CTC,
right,
which is one of the largest market making firms,
right.
And so I don't know how much retail technology you actually get to see or play with or that kind of stuff. But the retail technology now that our listeners use is amazing. I mean, it's free. It has everything, including everything from risk graphs and plot risk profiles to multiple volatility models.
It's better than Microhedge, what we used to use on the floor in the 80s.
And yet, at the same time, I want to be careful that we don't over analyze volatility to the extent where some retail customers focused on their volatility risk because they don't have enough capital to generally make volatility a part of the equation.
I mean, I've owned my experience is solely from the point of view of professional trader and market maker. But I always felt that the way for a retail customer to make money was to have an opinion about direction or market conditions, and then secondarily combine it with an understanding of volatility. I think if you're a retail trader, you still have to focus primarily on the direction of the market, and then secondarily to make sure you get a decent deal in whatever your strategy is to understand the volatility component.
We believe it's strategy driven, but it's the assumption needs to be directional. The assumption needs to be directional, but the process of making money is more strategic, even for the retail investors. Not to the same level that a professional is, but
Right, and I agree.
So I have a question for you. You obviously read When Genius Fails. Okay. There's all these assumptions about implied volatility and long-term implied volatility. I just have a couple questions on this space. First question is 25, like S&P volatility at 25 to 30 range, is that the new 15? So is 25 the new 15, or is 25 to 30 the new 15 to 20? Have we ratcheted up a notch just based on changes in the world and all this integration with all this global economies and stuff? Is simple question, is 25 the new 15? Because historical volatility would be around 15, 16%?
Yeah, okay. in the mid to upper teens. I mean, I remember we went through, 93, 94, one of those years in there where they were calculating the VIX was the old VIX.
Sure.
But it was under 10.
Sure.
Mm-hmm. I mean, and people can't imagine a VIX under 10. What do they say? The more things change, the more they stay the same. I mean, who knows whether it's cyclical or who knows whether it's a real change in the worldwide conditions. I think we used to only be affected by what happened in the United States.
Sure.
But now we're affected by so many more forces, what happens in the Far East, what happens in Europe, and maybe that leads to more volatile markets. And maybe it is a new standard.
New paradigm.
Yeah, that the VIX is maybe the average is the low 20s instead of the mid-teens.
Hey, when you look at a specific stock and you look at a specific stock, do you consider the implied volatility or maybe it'll be the projected volatility in that stock do you look at that as an opportunity? In other words, let me give you an example. There are some stocks with implied volatility right now, the VIX trading at 28 today. Do you look at stocks that have a 21 or 22% implied volatility, like, for example, McDonald's or Johnson & Johnson, which they're about 25% less than the S&P volatility? Do you look at that as an opportunity to bet on those stocks going sideways? And correspondingly, do you look at a stock, for example, like Bank of America or Citigroup or one of the financial stocks that has a volatility of 60 or 70%? Do you look at those as different, as in your mind, does that work like projected move? Do you think about that as far as what's your opportunity? Do you look at that as an opportunistic way to approach investing or trading or whatever you want to call it?
Well, here's the way I look at things.
Okay.
And it's probably, first of all, what's the implied volatility? What's the historical volatility been? And also, how does that fit in with similar types of stocks? In other words, if you're going to look at some automobile stock, the volatility, I want to know what's the typical volatility of other automobile stocks. What's the lot of correlation trading. Mm-hmm. A lot of big firms say you hardly ever look at anything in isolation. It's always a question of how does this look compared to other things that are similar or other information that reflects market conditions. So, I never look at anything in isolation. I always say, how does this fit into the group, or how does it fit into
or not fit in, meaning that
exactly, yeah. Then maybe there's
a play there.
Yeah, maybe there's a play there, exactly.
So with financial stocks trading at, let's say, 2 times, well, we can use lots of different things. Financial stocks being 2 times, let's say even right now, you traded on the board of trade. Did you trade bonds?
Yeah, I traded bonds for a short time.
So bond volatility historically is significantly lower than where it's currently trading.
Right.
Okay. So let's say right now we're trading at about 1.5 to 2 times historical bond volatility.
Mm-hmm.
So I'm a bond bear. That's my assumption. I think bonds are going to go lower. I think interest rates go higher, bonds go lower. With volatility trading at 1.5 to 2 times normal implied, is a reasonable assumption for me as a trader that I would assume that the velocity of the next move in bonds, if it happens, would be faster?
Well, you're making the assumption that the marketplace is right.
Of course. Don't you have to?
Well, but if you make the assumption that the marketplace is right, why do you want to trade? Because then you're just trading everything at fair value. I want to find something where I have a disagreement with the marketplace. And just to take your bond example and kind of going back to what I said earlier, then I'd want to know, what are the implied volatility of the 10-year notes? What are the implied volatility of the 5-year notes? What has typically been the relationship between those volatilities? Because maybe something is out of line within that family of products.
So we call it more of like a pairs trade. You would actually be looking at it more of like, I'm a seller of the 30-year note and a buyer of the 10-year note, because I think there's a correlation between the volatility that's off.
Right. Or, I mean, if the 2-year, 5-year, and 10-year note had a very, very well-defined correlation, and the bonds were really out of line at that with that relationship, then I might say, well, if I was willing to take a position in bonds alone, then maybe I would do one thing or another.
I'm intrigued by that because from a retail side, all I want is fair value.
Right.
So I look at it. I'll tell you, I don't know if it's right or wrong. I've always just assumed this. I look at it as if volatility is 2 times whatever the historical is, and I want to do something. When we're at one end of the extreme, I consider that to be an advantage to fuel what I call pot odds. So basically, I consider that to be an advantage on my directional bet, because if I'm right, there'll be some acceleration to my bet. Now, you said something very interesting, which is you look for more of something that's out of whack, like something that you think will revert to some mean or something, right?
Exactly.
Perfect. I mean, that's interesting.
No, but I do agree with you. A retail customer should be looking for fair value with respect to volatility.
Yeah.
And the advantage should be in the ability to predict direction in some sense.
So let's talk about it with one last area, which will be the financial stocks.
Okay.
So the U.S. financial stocks, based on what's going on around the globe right now, have a very rich premium. I don't know if the premium is because of the condition they're in here. I don't know if the premium is because of some global stuff. But they are trading at a rich premium versus historical. Mm-hmm. Do you view that as is there a way that you can look at that as opportunistic, or do you look at that as some other way?
Well, again, I would only look at it in terms of the relationship between the volatilities of the different products. I admit that when you're a volatility trader, it's very hard for a non-professional to capture that volatility value because of all the rehedging that's required.
Remember, we can only we on a retail level, and I'm a retail customer, and so is Tony.
Limited amount of
capital requirements are 20 times greater.
I know, and the transaction costs. They're gonna cost you also, and you're gonna get beat up a little bit on the bid-ask spread. I mean, if I had an opinion about which way the financial stocks were going, or any particular financial stock, I would try and look at that stock's volatility with respect to others and say, am I better off buying calls, selling puts, buying volatility, selling volatility, and still taking a directional position? And I mean, I think a great trade for most retail investors are vertical spreads.
Sure.
Because they have a volatility component, but they're also directional.
Hey, Shelley, I lied. I need one last question for you. On the professional side, getting back to the firm you work for, and it could be any firm, doesn't have to be them. Because I think this will put an interesting perspective on what our listeners hear us talk about all the time with respect to some of the differences between professionals and strategies and things like that. How much of the professional side of the business is volatility based? Meaning, how much of the strategies they use, the wealth that's created, how much of the profits are based on volatility bets as opposed to directional bets or whatever else you want to call it?
Well, I can only speak personally from my experience in my position with the market making firm. I would say 99.9% at our firm. Now, when you talk about volatility, you're talking not just about implied volatility,
Sure, of
historical.
course.
You're talking about volatility skew. You're talking about kurtosis, the whole volatility smile, and all the trading at our firm and at most of the other firms.
I
that
just
know.
wanted to hear you say some number higher than 80%.
Well, you-
Okay. And I'll tell you why, because people think that because the perception is out there that there's some brilliant person behind whatever firm it is that knows what's going to happen next. And the answer is they don't.
Sometimes people ask me, well, you have fundamental or technical analysts at your firm? Yeah, we have zero fundamental or technical analysts at our firm because we never take a position. If we have a significant delta position,
And we're talking about a big firm. How many people at the firm?
350.
350 people.
Yeah,
Okay.
if we have a significant delta position, somebody made a mistake. That's
Right.
I mean, somebody made a bad trade or didn't hedge
carry the
position.
one.
Yeah, exactly.
Hey, this was great, and I really appreciate you coming in. And as a show of as a show of good faith, for starters, because we got you out of your little protected world and coming out to talk to retail customers. I know it's
It's not easy coming out
it's
here.
not. It's great. It's awesome. And for a long time I've wanted to talk to you. Anybody, and this is the offer that we posted on our site this morning. Anybody that subscribes to take membership's $45 a year, and this will be the last time it's this cheap. $45 a year. We will send you a copy of Shelley's book, Option Volatility and Pricing. The book sells for, I think it's $65.
Something like that.
Something like that. You don't even know.
Right.
How many copies this year you sold?
You got that many royalty checks.
125,000 maybe?
Well, there's two books that have sold more than a bread box. One is Larry's and the other Shelley's. And this 125,000 kind of validates the thing. This is the Bible on volatility. $65 book, $45. We pick up the whole thing. There's the offer right there. You have to join today. We made an unbelievable offer to our listeners that are already members on Friday. And we thank you all for participating. Remember, everything had to be postmarked by yesterday, but it was an amazing offer and you jumped all over it and we love you for it. This is for people that have not yet subscribed. We have thousands and thousands of listeners that are just coming on board. They have not subscribed yet. You want to make a trade where you can't lose? Not too many can't lose trades. $65 book, you pay $45 for it. Signed, sealed, and delivered and sent to your house.
Right.
Okay. And direct from Amazon. It's a beautiful world. And we pay for the whole thing. And you're a member.
That's right.
And it covers you for the next year, and you get all the discounts and everything else, and it's amazing. And you support the cause, which is us busting our butts for you.
And you're grandfathered in from any price increases, blah, blah,
That's right.
blah.
So if you haven't purchased, here's another reason to. It's an amazing offer. This is a great book, and it's another form of engagement. Okay, so I'm hoping we spend about $10,000 today on your book. So make you into another #1 bestseller in the financial space. So everybody jump all over this. It's one day only, just for today. Okay, we'll leave this up there now. Shelley, thank you very much for coming in.
Thank you, guys.
Appreciate it, Shelley.